Welcome to the Deep Dive. Today, our mission is to cut through the noise of a pretty complex earnings call.
And we've got a fascinating one.
We do. We're tackling the Q3 2025 results from Granite Point Mortgage Trust, ticker GPMT. The call just dropped intraday November 6th.
Yeah, and this is crucial because GPMT gave us, well, a completely paradoxical set of results.
Paradoxical is the right word.
On one hand, you have this massive beat on their core metric, but on the other, a pretty significant distributable loss.
And what's so interesting is how the market reacted. It basically ignored the loss and focused on the credit story underneath.
Exactly.
The stock closed up almost 4% on huge volume. That's a powerful signal. So let's unpack that. Let's start with this mixed picture. What were the headline numbers?
Okay, so let's start with the good news. This is what really got analysts' attention. Revenue came in strong, around $13.9 million.
Wow. And what was the consensus expecting?
They were looking for about $9.4 million. So, that's a 48% beat, just an absolute smash.
Okay, but for a company like this, a commercial real estate emirate, revenue isn't really the whole story, is it? It's all about distributable earnings.
That's the metric that truly matters. DE, as they call it. For anyone listening who isn't, buried in these statements all day, just think of it as the real cash flow available for shareholders. It cuts out a lot of the accounting noise.
And specifically, it's the DE before they take any realized losses. That's the number that tells you how the engine is running.
Precisely. And on that metric, GPMT delivered positive 2 cents a share.
Which is just stunning, especially when you consider the street was bracing for a loss of 33 cents.
A huge turnaround. It tells you the core loan portfolio, the actual day-to-day business, is running efficiently.
And what was driving that?
If you look under the hood, net interest income was up 34% year over year, almost $10.5 million. And that was mostly because they've been reducing their overall debt and, just getting better borrowing costs. The core is performing.
Okay, but now we have to talk about the elephant in the room.
The loss side.
The loss side. The GAAP net loss was pretty small, almost flat. But that final official distributable loss, that was a painful minus 40 cents per share. Where on earth did that hit come from?
It was almost entirely an accounting move, really. It came from about $19.8 million in realized write-offs.
So about 42 cents a share right there.
Exactly. But, and this is the critical context management gave on the call, the vast majority of that amount had already been reserved for in previous quarters. They were just, formally taking the law on the books.
So this is the key, right? If they already reserved for it, why did the stock rally? A retail investor just sees that headline, a 40-cent loss, and they panic. Why did the pros reward the 2-cent operational beat instead?
Because the market is always looking forward. That loss, it wasn't a surprise. It was an action. It meant GPMT isn't just talking about cleaning house anymore. They are actually doing it.
Right. They're realizing the loss, using the money they set aside, and getting these troubled assets off the balance sheet for good.
Exactly. So the stock closing up 3.8% on, 5.6 times the average volume.
Yeah.
That tells you investors believe the worst of the provisioning, and more importantly, the uncertainty, is now behind them. They're buying into the de-risking story.
Okay, so let's dive into that de-risking strategy because it was really the theme of the whole call. Management said they are all in on preserving book value and resolving credit issues, even if it means sacrificing near-term growth.
And you can see it in the numbers. The clearest sign is just how much they've shrunk the business. Loans held for investment are down 18%. Just since the end of last year.
18%. That's a huge deliberate contraction.
It is. They're selling assets, taking repayments, and just shrinking the portfolio to get liquidity and get rid of the problem loans.
And even with that big realized loss this quarter, the balance sheet held up remarkably well. Book value per share only dropped 5 cents. It's holding at $7.94.
That's a crucial data point because it shows the strategy is working. They're cleaning up the book without destroying the underlying value.
So how are they pulling that off? It seems to come down to the reserves.
All about how they're using their reserves. We have to talk about CECL for a second. It's basically an accounting rule that says you have to estimate your future losses and save for them now.
So you're building a rainy day fund.
Exactly. And GPMT has been building a very big one. Their total CECL reserve is down to about $133 million.
Down from almost $200 million at the end of 2024.
Right. And it's not down because the loans magically got better. It's down because they used the reserves to cover that big write-off we talked about. They're finally taking the pain they already accounted for.
That shift from building reserves to using them, that's the signal the market is latching onto, isn't it?
It absolutely is. It implies they feel their estimates are now solid, that they don't need to keep hoarding more cash against future defaults. They believe they have a floor.
And they gave a couple of really good examples on the call that sort of bring this to life.
They did. The first one was a clear win, a student housing loan in Louisville. They resolved that one for more than what they were carrying it for on the books. It actually generated a $3 million GAAP benefit.
So that's just a pure validation of their model. A loan they thought was troubled actually turned out better than expected.
Exactly. And then you have the more complex one, the big troubled loan in Chicago that was part office, part retail.
This one really shows the surgical approach they're taking.
It does. This is where most of that big write-off came from, about $19.4 million. But here's the brilliant part. They basically carved out the toxic office component of the loan. They took the loss on that piece.
And what's left?
What's left is the collateral they kept, which is 100% prime retail space on Chicago's Magnificent Mile.
So they took the punch, cleaned the balance sheet, and now the asset that's left over is much cleaner, higher quality, and way more marketable.
A perfect example of preserving book value while you absorb the hit. The loan book is smaller, but it's a lot healthier.
And they're also doing the boring stuff right too, managing their own debt.
Yeah, that was another good sign. They extended one of their main credit lines out to December 2026.
Removes a lot of near-term risk.
It does, and they got a great deal on it. They cut the interest rate spread by 75 basis points. Management said that alone will add about 3 cents a share to earnings every year.
That's just smart management.
It is. And the portfolio that's left, about $1.7 billion, it's 97% floating rate, so it benefits from higher rates. The yield is already 7.5%.
So all this points to, a company that is getting its house in order. But that brings us to the big but. The growth overhang.
The billion-dollar question.
For all this great cleanup work, management was very clear. New originations, new loans are basically on pause, and that's what's keeping a lid on the stock.
Yeah, the guidance was, well, it was sobering. They don't expect to start meaningfully growing the portfolio again until mid-2026.
Mid-2026, that's a long time to wait.
It is. They said repayments and resolutions are just happening slower than they'd hoped, especially in those really stressed parts of commercial real estate they're trying to get out of.
And that delay is exactly why GPMT is trading at, 0.3 times its book value?
Around there, yeah. The market is basically screaming that it doesn't believe that $7.94 book value is real, or that the cost of waiting until mid-2026 is just too high. It's priced for permanent damage.
And that discount is one of the deepest in the whole sector.
It is. And it's partly because GPMT is more focused on that middle market commercial real estate space.
Yeah.
It's just had, weaker liquidity, less price discovery than the big institutional markets. It's why the stock has lagged the broader REIT ETFs.
Which brings us to the core debate for any investor looking at this. Is this a classic value trap, or is it a deeply discounted optionality play?
And the case for optionality rests almost entirely on those credit reserves holding up. I mean, look at the coverage on their worst assets. They have $86 million set aside for just 3 non-accrual loans.
And the total balance on those loans is what, under $200 million?
$196 million. So that's a 44% coverage ratio. They've already reserved for 44 cents on every dollar of their worst loans. That is a massive buffer. So if management can just execute this cleanup, and Q3 suggests they can, and if they keep that book value from eroding much further, then the stock is primed for a huge return just by closing that valuation gap.
The market just wants to see it done, not just underway. That price reflects the risk of waiting.
Which is a fascinating setup. If you believe the story, if you believe the reserves are enough, that price gives you a huge margin of safety.
All right, speaking of taking a calculated risk, let's shift gears. It's time for our favorite segment. This is where we pitch let's call it an outrageous but plausible trade idea.
And just to be very clear, this is not financial advice. It's a thought experiment.
A thought experiment for a very risk-tolerant investment committee. What's the pitch?
The core thesis is simple. Q3 proved that a credible floor is now in place for GPMT's book value and, by extension, its stock price.
The market is pricing for disaster, but the evidence suggests the worst of the provisioning is over.
We believe that credit floor is going to hold, and the optionality in the stock is huge, given that discount to the $7.94 book value.
So we want to play that optionality, but we also want to get paid while we wait for that mid-2026 growth story to kick in.
Exactly. So the trade we're pitching is a bit aggressive. It's a long position in GPMT common stock, combined with a short position in deep out-of-the-money puts.
Okay, break that down.
So you're buying the stock because you believe the price will eventually move back up toward analyst targets, which are around $3, $3.10. At the same time, you are selling put options that are struck way below the current stock price.
By selling those puts, you collect cash, you collect premium income.
Right. And you're basically making a bet. You're expressing your conviction that the book value is resilient and that GPMT is not going to suffer some catastrophic unreserved loss that would send the stock plummeting past your put's strike price.
You're getting paid to say, I believe that 44% coverage ratio is for real.
It's a strategy for someone who can stomach the volatility, but whose confident management has this under control. The income from the options helped you get through that long waiting period until mid-2026. If it works, you get the option income plus the stock appreciation.
A great summary. We've covered a ton of ground today. The massive core earnings beat, the necessary distributable loss from the cleanup, and that critical delayed growth timeline.
At the end of the day, the question for investors is pretty simple. Does the visible progress on credit justify holding on through this deep discount?
Right. Is the cleanup real enough to bet on?
And looking ahead, I think the provocative thought is for management. They're focused on preserving book value, not earnings. So the question is, what specific macro signal, beyond just the Fed cutting rates, would give them the confidence to finally pivot, to go from defense back to offense and start originating loans again?
That pivot point, that's what everyone will be watching for.
That's the signal that the waiting is over.
A perfect place to leave it. Thank you for joining us for this deep dive into the Granite Point Mortgage Trust earnings call. We hope this gave you a clear map of what really matters.